Hello everyone, it's Mark Masterson, partner and CIO here at Hightower Naples, and I'm coming to you with our fourth quarter video market commentary. Third quarter was eventful, and we have a very interesting setup here as we move into the fourth quarter, which is why I'm calling this commentary, It's About Time. And I think you'll see what I mean as we move through, so let's go ahead and jump right in. As we move on to the four horsemen, you're going to notice that the four horsemen have a little different look to them. For example, we've got a lot less red. So the fundamentals, they remain bearish. Reason why is because recession risk remains elevated. I'm going to show you that as we move through some of these pages, but it's some of the same culprits like the yield curve, the variable long lags from the Fed rate hiking cycle, leading economic indicators, bankruptcy. The economy is caught between the pretty modest growth right now and the potential for the Fed's rate hikes to hit the mark. So it's about time for that to come to a head, frankly. But on the technical side of things, definitely move to neutral. Why? Because by most of the indicators I follow, most assets are now pretty oversold. And that would warrant a bounce, whether that's stocks, bonds, commodities, they all kind of fit the bill. And on the other side of that, the dollar and bond yields are now very, very overbought, and technically they're due for a decline. So this could have easily been on the bullish side versus neutral for sure. Sentiment is bullish because, again, sentiment is a contrarian indicator, and now sentiment has been fairly well reset. You know, equities of investors are now a lot less confident than they were a month ago. Gold, commodities, all been reset there. I'm going to show you all of this, but it's about time for sentiment to have its time to shine as a contrarian indicator. And lastly, on policy, it's neutral because on the one hand, the Fed is still hiking and higher for longer, and QT still going on. So we do have the Fed trying to slow the economy, but at the same time, fiscal policy is ridiculous. They're spending at drunken sailor levels, and it's offsetting the Fed hikes. So these two are kind of fighting each other to a more neutral stance. So I'm going to jump into some of these as we go, but I wanted to kind of cover the four horsemen. Let's move on to some of the details. So here's the executive summary of what we're going to see today. On the economy, complacency is still a little high regarding a recession. It is about time, as I talked about, for this to come to a head one way or another. The Federal Reserve, Powell's in a box. I'm going to tell you why. Higher for longer versus the reality of those higher yields. And it's about time for a pause. Capital markets, equities, it's about time for a bounce. Bonds, it's about time for yields to rest. Commodities, it's about time for a dollar to pause and commodities to benefit. And from a sentiment standpoint, we're definitely bearish enough to see a change there, and it's about time there as well. So let's dive into all of that. Moving on, let's go into the economy. We know this is one of the primary forces at play. So we've had inflation, and to fight the inflationary component, we've had the Fed using its tools, both quantitative tightening and rate hikes, and they've been hiking rates since last April. They actually did one more here to get us up to about 5.5%. And there's about a 12 to 18 month lag between when these rate hikes hit the economy. So technically, we're only about halfway through the rate hikes here through October. That'd be 12 months from now. And all of these other rate hikes have yet to really filter through the economy. So we're nearing a time when we're going to see that take place. At the same time, we've had a tremendous amount of fiscal spending going on. Fiscal authorities have been pushing their own agenda, if you will. They're spending like drunken sailors, like I said earlier. Just to put it into a perspective, $6.7 trillion, according to Bank of America, was spent over the last 12 months. That's about $900 billion less than when $4 trillion was handed out during COVID. Deficit is expanding, as we know. So the real question is, while this has been both inflationary and supportive to the economy, the question is how long that can continue. It's not just this past year. In fact, the last 3 years, we have seen we're on track for the 4th consecutive year with the $6 trillion or more in government spending. Again, supporting the economy, no doubt, but also inflationary. And the challenge is that puts Powell in a box. As we know, Powell is fighting inflation, and he's doing that, trying to slow the economy to lower inflation, trying to create a soft landing. Easier said than done. And at the same time, those policies, because they're more hawkish, are pushing the dollar up to levels that can potentially cause harm. The dollar we're going to cover this later, but the dollar's up 12 weeks in a row. So while he's fighting inflation, he's also got the economy on his mind, because the fiscal spending is inflationary, counterbalancing his fight against inflation. And yes, it is stimulating the economy, counterbalancing his fight to slow the economy. That fiscal spending is also pushing up bond yields to levels that can break things in the economy. So we're going to have to look at this, but it's about time for Powell to near this choice between fighting inflation and supporting the economy. We're going to cover that a little bit later. One of the things that Powell's got to deal with, it's getting harder, is inflation has stopped going down. So you can see CPI had been going down for months and months and months, but the last 3 months it's gone up. In fact, if you take August's CPI reading, it's about 8% a year. So you can see it's turning up. You can see the PCE, which is just another inflation metric, has turned up. And what Powell's trying so hard to do is avoid what happened during past inflationary cycles. The blue line is the one that we're on now. All these others are cycles from the 1910, 1930s, 1970s. And you can see inflation came in waves. You went up, down, but then you had a second wave. And you can see this is curling up, and Powell does not want to have a second wave. But again, he's got some very, very tough choices to face, because while he's fighting inflation, there are still signs that the economy may be trying to slow. So here are a couple of those signs, and I'll move through them quickly because you see them in the morning roundup. Leading economic indicators are now down 17, not 16, 17 straight reports. That's a pretty long time. It's uncomfortable, frankly, where leading economic indicators have had that long of a streak of falling. At the same time, banks are in trouble, and so banks are tightening their lending standards. And when they start to tighten lending standards, usually you'll see these vertical gray bars. Those are recessions. So when lending, you had the 2001 recession, you had the 08-09 recession, you had 2020, and here we are again. So banks are starting to tighten down. The consumer's struggling a bit. Credit card delinquency rates are rising, and we know that because consumers are spending more on credit to offset inflation. Household interest expenses is a much higher percentage than it was. In fact, it's the highest level on record, because yields have gone up. Interest on credit cards, interest on mortgages, interest across the board is a much bigger bite to the consumer. And the consumer is a huge part of our economy, of course. The yield curve inversion, we know that. I've covered that before. It's got a very good historical track record of predicting a recession, just not a good timing tool. But as you can see, we're now 218 consecutive days in the yield curve being inverted. That's a long time. It's historically very, very long. And it's been very, very deep. As you can see, normally when the yield curve gets inverted, you end up with some kind of a recession, as we have the last few times. That's nothing new. You know that data. You can see on this one's a better looking chart that kind of shows this is how long and deep in blue. It's inverted, of course, but the yield curve was inverted. These are all different times that it had been inverted depth, and all these red lines are recessions. So, they're correlated, just a matter of trying to determine the best time. But it certainly suggests that a recession is possible, if not even probable, at some point down the road. And as I put in today's morning roundup, this is interesting. So typically, you're much nearer a recession once the yield curve inversion turns back up. And as you can see, we're starting to see it. This is from today's roundup. So it's hot off the press. And Bond King Jeff Gundlach noted last night, U.S. Treasury yield curve is de-inverting very rapidly. It was at minus 108 basis points a few months ago. Now it's at minus 35. which should put everyone on recession warning, if not recession watch. So the yield curve is kind of telling us something, that at least we're not out of the woods. This is one that I don't really follow, but it's a less known metric, GDI, gross domestic income, but it's very good at predicting recessions. In fact, it's 12 for 12. And when it goes negative, you see a recession. You can see it every single time that it went negative, there was a recession. And of course, we're negative today. Question is timing. Nobody really knows. But historically, the average, it does take time for a recession to show up once the yield curve gets inverted. The average is actually 10 months, and we're now 15 months into this time period of inversion. So that brings me back to this question on the it's about time for Powell to be facing a difficult choice between his inflation fight and saving the economy. I would tell you the answer to me is he's always, and the Fed is always going to favor the economy over inflation. You can see it in the next chart. This is a history that shows in the blue line is when they would hike rates. And every single time you face some kind of a crisis or a recession, what happened to the Fed funds rate? It came south. So the Fed's always going to be looking to bring those rates down in the event that we do see a recession, just like here. Even in the 70s, when we had an inflationary cycle, every single time they came down. So keep that in the back of your mind. I'll share a couple of other quick slides that tell me that Powell's in a box. It's notable for Powell in particular that it's not just the inflation and the economy, it's also yields. I've heard it said that the Fed's third mandate is to make the Treasury look solvent. It's not just inflation fight and price stability. And Powell has his work to do on that front, because coming back to the spending, as I said, take a look at this in terms of deficits. We've been running deficits for 4 years now with those 6 trillion plus a year. Since 2020, we've had 14 trillion in fiscal spending and balance sheet expansion. Obviously, the national debt is over 33 trillion today. We added about 11.5 trillion just in the last 5 years, and the debt ceiling is uncapped. We have about $7 trillion that's coming due in the next 12 months. You can see that here. 32% of all the outstanding debt comes due in the next 12 months, and that's going to be refinanced at a higher rate, not at the current. So that's with yields up, it's going to be refinanced at 5%. What that's doing is it's pushing the interest payments on government debt up to $1 trillion now. Why is that significant? Because it becomes the largest budget item in the government. Right now, it's been military, which is north of about 800 billion today. But at $1 trillion, interest becomes the largest budget. So the Fed cannot ignore the impact of higher rates on both the economy and the federal government. I think that's notable, especially because your next question may be, well, just spend less money, right? Well, that's true for you and me. But remember, it's an election year, and spending supports the economy. Yes, it is inflationary, but it's an election year. And look at this chart. No recession. So the fact that every president who avoided a recession in the final 2 years of their first term went on to win re-election, that matters. And every president who had a recession in the final 2 years of their first term went on to lose re-election. Here's the numbers. So keep that in mind when you consider the fact that our government may spend less the next 12 months. Even though I find it very hard to believe that they can spend another 6.7 trillion, these statistics do make me pause and consider the possibilities. And I do think there's a reason why there's never been a recession in year 3. And we're seeing it as the government spends an incredible amount of money to keep it at bay. But that puts Powell in a box, as we talked about. So let's move on to the capital markets. Let me start with the quick scorecard at mid-year, and I would just say it's been one of frustration. You can see across the board, bonds are down, stocks are mixed. Yes, the S&P is up 13. It's actually only up 10 now, but it's still been very, very modest for most equities. International's down, small caps are down. Commodities are now down to flat. So it's been a frustrating time for capital markets. This is updated through today. You can see about that 10% return on the S&P. Most of the stocks in the S&P are down. As we know, if you take the S&P 500 and you equal weight, the top 7 names, the big tech names that have held it up, it's actually negative on the year. And the Dow's now negative on the year. So that's been a challenging time in equity markets, and it hasn't been one of a very broad-based rally, which is what we normally see coming out of bottoms. The recent decline in the S&P has actually proven to be the deepest of the year so far. You can see it's even deeper than the one we saw during the bank crisis back here. And that set the stage, to me, to suggest that it's about time for the markets to kind of find their footing here, at least for a period of time in October, because we are in the seasonal part of the year. You can see the fourth quarter tends to be the best time for markets. It's the best quarter traditionally. And in an election year, normally there's a pullback in August, September. That's the gray line. And then the fourth quarter, you see a rally, and we kind of saw the same thing. So we haven't seen anything unusual. And from a seasonal standpoint, it's about time for the markets to find their footing and have a rally. In today's morning roundup, I highlighted how oversold the market is. It's getting pretty oversold. In fact, only 8% of all stocks, which you can see in this red line here, are above their 50-day moving average. And so that's the lowest of the year. You'd have to go back to last October's low to find something lower than that. And before that, again, May, June window of the year before. So it's a pretty oversold condition. Now remember, oversold is a condition. It's not a catalyst. We have to get the catalyst. But the condition of being as oversold as it is kind of like tinder. And once you light it, it creates a nice bounce, a solid bounce. Here's another chart from today's roundup showing the McClellan oscillator, just another indicator I keep track of very regularly. The green is kind of a buy zone typically, where the markets tend to want a bottom. Red is when things are getting overbought, and we're just now peaking in there. So it's, again, not a condition. It is a condition, not a catalyst. Another condition that looks ripe is sentiment. I mentioned earlier that sentiment is now bullish. That's because on equities, this is the sentiment trader, smart money, dumb money. But a couple of months ago, the dumb money was really, really bullish. And now that the markets are down 7 or 8%, they're getting almost too excessively bearish. In the past, these have been pretty meaningful lows, but you can get bottoms before that, and we're kind of in that range. Again, short term, it's about time based on retail sentiment. You can see the 2-month change of bullish to bearish sentiment, retail sentiment. There's a lot of retail traders who are now very, very bearish based on a 2-month change. It's one of the more meaningful swings. So that's a big swing. And again, it suggests that it may be about time for equities to find their footing. But that's all based on short term for equities. So I'm going to come back to equities. We're going to move on from equities. I'm going to come back to them at the end. But certainly it's about time for equities to experience a bounce. They're just waiting on a catalyst. So moving on to fixed income. This may be one of the catalysts. And I don't normally spend a whole lot of time on bonds, but they're just taking center stage today. So it's really important that we look at it, because if you take a look at this chart, you can see this is a weekly chart of the 10-year Treasury yield, and it's just marching higher, 22 almost straight weeks higher. And that has been a catalyst to the downside for most assets as yields have been pressing higher. But I think it's important to note that when you look at the daily chart, it's now very overbought. You can see it here. And each of these times, these blue arrows where the 10-year yield got overbought, even in the uptrend, it was a point where the 10-year yield would take a breather. So I think it's about time for these 10-year Treasury yields to take a breather, and it can become a catalyst. But don't ignore the fact that this rise in 10-year Treasury yields is the biggest in history. This goes back to the 1960s, and this has been the largest rise in 10-year Treasury yields. That's notable. That has an impact, and again, that goes back to the box that Powell's in, that he can't ignore that. He may in the short term, but that's a huge move for 10-year Treasuries. And what it's done is it's pressured bonds. So if you take a look at the 10-year Treasury bond, we have 3 years now in the red. if you look at this entire box going all the way back to 1928, you're not going to find 3 red boxes in a row. This would be a first. Now the year's not over yet, so this may yet turn green, but you can see this is the 2023 year-to-date, 3rd consecutive year of decline. It's the worst. It's been a rough go for fixed income, and it's due for a bounce, no doubt about it. Sentiment in bonds doesn't get much worse. So sentiment tells us it's about time. If sentiment is a contrarian indicator, then sentiment's kind of screaming at us on that front. And also don't forget, lastly, that if the economy does slow, as Rosenberg points out here, normally bond yields will peak before a recession and then fall through the recession. So if the economy is going to slow either later this year, early next year, as some of those other indicators are telling us, then bond yields should, decline and be a potential catalyst there. The other catalyst may come from the dollar. As I mentioned earlier, the dollar has gone up now 12 weeks in a row. It's been a wrecking ball, really, kind of a global wrecking ball. It's a very strong run. This has happened before, but it's pretty rare. The reason, of course, the euro is down 12 weeks in a row. That's never happened. So this could be a possible catalyst if we finally see the dollar pull back. And again, similar to treasuries, you can see it's just super overbought. And most of the time when you get overbought like this, it becomes time for a rest. So hopefully, even if we just pulled back to the, the 200-day moving average here, that rest would be enough of a catalyst for the dollar to take a breather here and for the stocks and other things to have a rally. Where would that catalyst come from? Well, in the morning roundup, I actually have talked about this a few times. Last October, when the dollar was ripping higher, the catalyst came from the Bank of Japan, not the Fed. The Bank of Japan came out and they announced that they were going to strengthen the euro against the dollar. And so this is actually a chart here that shows that. So once the yen had reached 150 versus the dollar, the Bank of Japan said no mas, because the yen was just collapsing. And they started buying it. So you can see they were just hammering it. And that as that went down, as the dollar versus the yen went down, the dollar was pulling back. So now you've seen this strengthen. We're back to 150. And wouldn't you know it, just last night, Japan's top foreign exchange diplomat said they will take appropriate steps versus excessive yen moves. So we're starting to hear some chatter that maybe the Bank of Japan is going to intervene again, strengthen the yen, which could weaken the dollar. Sentiment in the dollar is now getting excessively bullish, just another contrarian sign that maybe it's time to take a breather. On the other hand, let's look at other assets, commodities, an asset class that I like. We've been fans here. We think there's a serious potential for this to be one of the better performing assets. And you can see it's just been kind of churning along in a big rounded bottom. It's actually held up quite well in the face of higher yields in the dollar. The bigger picture, longer term, looks pretty good. This is a chart that shows the commodity index versus the S&P. When this is rising, commodities are outperforming stocks. When it's falling, stocks are outperforming commodities. That's been going on for a long time. It's due to turn and head higher, and that should be a tailwind for commodities. Same thing for the Dow. This is the same thing, commodity versus the Dow, not the S&P. Looks the same. It's due for a turn. And this study that I've shown you before suggests that commodities go in 10 to 15 year windows of outperformance versus stocks, and it tends to flip-flop. We have, according to this study, we're just starting the up cycle for commodities. So again, it could be a potential catalyst. You can see this is when the 15-year periods when commodities outperform stocks, and then there's periods when commodities greatly underperform stocks. And we just went through a period most recently through where stocks were up 250% and commodities were nothing. So the next 10 to 15 years should look quite different. And here's another visual of that. This is a chart I just put out there. This shows the return of all assets going all the way back to 2001. And look at the one asset class that was negative over that period, and it happens to be commodities. So mean reversion suggests that there may be some potential there. And sentiment on commodities is pretty neutral. I'll just take a quick look at gold because that's one of the individual commodities that we hold. Still in a very large base. We had the huge bull market. We had this 12-year sideways correction, and it's been trying to tap the top of that. And remember, the longer the base, the higher in space. So when this thing finally breaks out, I really do believe gold's going to have a pretty good run. And the recent decline in gold has allowed the weekly chart to get oversold. I've covered this before, but almost always when the weekly chart gets oversold, you're nearing a pretty significant, often at least a low, but sometimes a pretty significant low. So I think we may be nearing that point. And this is the chart of gold compared to the S&P. And as you can see, again, when it's going up, gold is outperforming stocks. When it's going down, stocks are outperforming gold. We've had a long period of stocks outperforming gold, so we may be entering a period here where gold would outperform stocks. And sentiment in gold is terrible. So the recent decline in gold has certainly beaten sentiment up enough to justify a bounce. So I mentioned to you, after going through all of those, I was going to come back to equities. And the reason why is I want to, while I do believe that it's about time for a strong rally, or at least a shorter term rally across multiple assets, including equities, I want to show you a few things just to suggest and remind us that it may not quite be time for the equity bull to resume in earnest. First of all, remember, at least historically, we've never had a market bottom occur before a recession starts. So keep that in mind. It just suggests that the ultimate bottom for stocks may still be out ahead of us. Take a look at this chart. This just reminds us that it's a process. First, the Fed pauses, then you get a Fed rate cut, then you get a recession, then you get the S&P low. At least historically, pause this, study this chart, if just to remember that there can be a process to this that can take time. This was a good chart. I just got this from my son. Ultimately, it comes back to the yield curve, and it shows that when the yield curve is at extreme negative levels, as it's been, it's starting to change, but as it has been, typically the S&P average one-year return was a modest decline. So it doesn't suggest a big downside, but it also doesn't suggest a lot of upside when the yield curve has been down. It's not a perfect indicator. It's about 50-50, but it's interesting to note because this yield curve inversion has been deep. In fact, at its worst, it was in the third percentile of all historical readings going back to 1962. And you can see on this chart when the yield curve is below the 10th percentile, these red dots suggest that most of the time it's kind of either right at or right after an S&P peak, and you kind of have some bumpy markets. So it's just something to keep in mind that the yield curve is still suggesting maybe some caution longer term in equities for the next, maybe intermediate period. I've also highlighted how investors really haven't sold anything. We're still at 60% holdings average in terms according to Bank of America for equity holdings. And normally bottoms see investors sell more than that. Here was 56, here was 54. Of course, this was the global financial crisis, 39. So not seeing a lot of real capitulation or fear through any of this. And another chart that shows that historically, when the household equity exposure is very high, which it was here, and it was recently last year, the market tends to go through kind of a choppy sideways move, rather than taking off. So usually the big bull markets begin from a lower level. You can see that, when we got down here, it kicked off a big rally, and here we are. Maybe we just have to kind of chop back and forth a little bit to take care of that. And lastly, in the commentary from last quarter, I shared a tidbit from Bob Farrell, an old Merrill Lynch legend. And what he said was, typical bear market path had a sharp down, a big reflexive rebound, and then a drawn out fundamental downtrend. So just keep that in mind. I do. So here was the sharp down, here's the reflexive rebound, and maybe we just have to grind, into the next few months and quarters, bouncing around, until we kind of reach an ultimate low. That's a possible path. So those are the reminders that while it's about time for the markets to experience a bounce here, it may not quite be time for the full bull market to resume. So that's it, wrapping up the commentary for this quarter. It's about time. it is about time for some positive things to take shape here in the near term. It's about time to get some answers on the economy and the Fed rate hikes, and it's about time for Powell to face a little bit more of a challenge in his role. It's not going to get easier for him. I'm not a real defender of the central banks, but I think he's done an admirable job so far, but I think his job's about to get more difficult as we kind of balance these things that are going on together. So let's stay in touch. As you know, you can reach out to us at any time, and you can reach us at our in emails. You can reach myself or Dave. Please feel free to give me a call if you want to follow along the morning roundup daily. I'll be happy to add you to that. We appreciate you being here. We appreciate your friendship and trust and confidence. And we look forward to talking to you soon.